The housing crash of 2025 is no longer something ahead of us. It's happening right now, unfolding dramatically before our eyes. Cities that once buzzed with prosperity and growth now find themselves buried beneath an overwhelming flood of for-sale signs. Prices are falling at a pace few could have imagined, slashing through neighborhoods and communities that once seemed untouchable. Sellers are panicking, desperate to cut their losses, as the market feels like it's slipping out of control. In the hardest-hit areas, home values are collapsing with staggering severity, diving anywhere from 50 to 80%. This isn't business as usual. It's far worse than what many remember from the darkest days of 2008. Builders who once poured resources into construction are now openly worried, unsure of what lies ahead. Buyers, once eager and competitive, have seemingly vanished, overwhelmed by soaring mortgage rates and economic uncertainty. Investors who previously chased quick profits are now scrambling to dump properties before the market implodes entirely. These 10 housing markets are not merely facing a crisis. They are the undeniable epicenters of this unprecedented collapse, and the pain, tragically, has only just begun. Number 10, Sacramento, California. Let's start with Sacramento. Once seen as the affordable escape from soaring Bay Area prices, it became a magnet for people fleeing the coast during the pandemic. Home prices surged more than 40% between 2020 and 2022, peaking around $540,000. It felt unstoppable, but now in 2025, the story has flipped. Prices have dropped sharply to about $450,000, a tough 16.7% loss, wiping out nearly $90,000 in value. The influx of buyers from the Bay Area has slowed to a crawl, and that earlier boom now feels dangerously fragile. Mortgage rates near 7% are pushing the limits of what local buyers can afford, especially with median incomes around $75,000. Meanwhile, inventory has exploded, up 46% from last year, leaving many homes sitting unsold and price cuts everywhere. If things worsen, expect this trend to speed up as investors pull back and migration slows further. Sacramento isn't new to pain. It was a key spot in the 2008 crash, and today it's hanging on the edge again. For anyone who bought at the peak, significant equity losses may be coming. What was once a refuge now serves as a warning. Rapid growth can turn fragile in the blink of an eye. Number 9. Denver, Colorado. Denver, the mile-high city, has always captured imaginations with its breathtaking mountain views, vibrant outdoor energy, and fast-growing tech scene. In the not-so-distant past, remote workers and ambitious young professionals rushed in, drawn by opportunity and the promise of the Colorado lifestyle. Home prices soared, rising more than 50% since 2020, propelling Denver to the top tier of the country's most expensive interior markets. But in 2025, the story has changed. Warning signs are everywhere. Inventory has leapt 38% over the last year, while homes are lingering on the market for an average of 75 days, much longer than Denver's used to. Affordability has stretched thin. Mortgage rates hover near 7%. Buyers, many already carrying high debt, are barely holding on. Now imagine what happens if tech jobs start shrinking or layoffs hit hard. Suddenly, fewer people move in. The influx dries up. Demand drops. That's when surplus homes pile up. Prices could slip by 15 to 20% or even more. The entire market feels unsteady, almost like Denver's staring at a replay of the 2008 crash. If the economy stumbles, homeowners, especially those with tight budgets, will face immense stress. Some might have to sell fast, adding even more homes to a market swimming in inventory. Price cuts would multiply. Equity could vanish in months. For a city that once felt unstoppable, Denver now serves as a warning. Boomtown fortunes can shift quickly when confidence slips and the risks become real. Number 8. Bakersfield, California. Bakersfield never set out to be glamorous, but its unbeatable affordability made it the ultimate magnet during the recent housing boom. As prices soared out of reach in Los Angeles and the Bay Area, people flooded into Bakersfield, lured by open spaces and the promise of a fresh start. Home prices surged from just $240,000 in 2019 to nearly $440,000 by 2022. An eye-popping leap for a city once considered sleepy and overlooked. But by 2025, the scene has changed dramatically. Bakersfield is now grappling with a fierce downturn. Prices are dropping fast, and buyers are disappearing even faster. Sometimes it feels like they vanished overnight. The city's old superpower, affordability, has flipped into a huge red flag. While home values nearly doubled, local incomes just didn't keep up. Wages have barely budged at all. That growing gap created a risky situation, making the market dangerously reliant on people moving in from elsewhere. Mortgage rates are now stuck near 7%, and the monthly payment for a median home has blown past $3,200, a price few local families can actually afford. The squeeze is suffocating. Investors once bought nearly 1 in every 4 homes here, gambling on fast profits. Now that gamble is backfiring big time. Those investor-owned properties are being dumped on the market at steep discounts, anywhere from $50,000 to $100,000, just to avoid even deeper losses. With inventory still rising and local wages frozen, Bakersfield faces a harsh reality. Some experts warn that home values could collapse by as much as 60%, dragging prices all the way back to pre-pandemic levels. That's not just a correction, it's a second, even more punishing crash. In a place built on the promise of affordability, the very thing that made Bakersfield attractive has become its Achilles heel. Number 7. Tampa, Florida. Let's shine a light on Tampa, once the undeniable rock star of Florida's real estate world. In the early 2000s and 20s, the city was fast-growing, brimming with jobs, and buzzing with energy. Tampa became the hot ticket on the Gulf Coast, drawing in everyone from remote workers and retirees to deep-pocketed Wall Street investors. That tidal wave of demand pushed average home prices to a jaw-dropping $383,410 in 2022, with bidding wars erupting everywhere. Clear signals that a dangerous bubble was already forming. But jump to 2025, and that sizzling momentum has vanished. Prices have slipped to around $360,130, and a far more worrying sign is flashing. Inventory is up by over 55% compared to last year. Homes that used to disappear from the market in less than 2 weeks are now sitting unsold for 75 to 90 days. Meanwhile, the once booming short-term rental game has collapsed, flooded by a swarm of Airbnb landlords, all trying to unload at the same time. The problems run deeper. Mortgage rates are stuck around 7.5%, shutting out would-be buyers and making it harder for owners to find an exit. The breakneck growth that once powered Tampa forward has left the city teetering on the edge, overvalued, oversupplied, and showing all the classic signs of a bubble ready to pop. If these trends keep going, Tampa faces a serious correction that could send shockwaves far beyond its famous beaches. Number 6. Sedona, Arizona. Let's head to Sedona, a town that looks like something from another world, famous for those breathtaking red rocks, buzzing art scene, and an almost mystical vibe. Sedona's one-of-a-kind charm lured in a wave of wealthy buyers and retirees, turning it into one of America's hottest luxury markets. At its peak, home prices here soared to around $850,000, fed by steady streams of outsiders snapping up second homes or seeking a peaceful retreat. But 2025 brought a sharp and unexpected reversal. Suddenly, Sedona's market is feeling the pain. The luxury bubble has popped, and what was once a magnet for prosperity is now facing something close to a ghost town scenario. A national slowdown and those stubbornly high 7% mortgage rates have sent affluent buyers back to the sidelines. People who might have bought a vacation home are hesitating. Luxury spending is on pause, and high net worth buyers are holding back. As a result, inventory has jumped more than 35% from last year. With high-end homes now sitting on the market for 100 days or longer, price cuts are everywhere, especially on those million-dollar properties that once sold with ease. Investors who banked on the short-term rental bonanza are now pulling out, squeezed by falling profits and rising costs. Add to that Sedona's high cost of living, steep HOA fees in exclusive neighborhoods, and climbing wildfire insurance premiums are piling on the pressure for current owners. For anyone drawn by Sedona's beauty, 2025 presents a harsh wake-up call. The dream of a tranquil mountain retreat has become a financial trap. The market's glory days have faded, leaving behind empty houses, anxious sellers, and a landscape of quiet uncertainty. Number 5, Dallas, Texas. The gleaming heart of North Texas, a symbol of relentless corporate relocations and a seemingly endless economic boom. Dallas has been a magnet for population growth and massive real estate investment. Its sheer scale and rapid price appreciation make it a definitive ground zero, where the Texas housing bubble inflated to monumental proportions, now making it a city to avoid. Dallas's explosive growth was fueled by massive corporate influx, a booming tech sector, and a reputation for endless opportunity. This led to rapid price appreciation, often 60 to 80% since 2020, and a furious pace of new construction across the metroplex, particularly in the northern suburbs. This aggressive, widespread building and price surge was a clear symptom of the bubble's formation. If you're finding this deep dive into America's collapsing markets indispensable for your future, please gently hit that subscribe button to Invest USA. Your support powers our vital investigations. Now the chilling signs are setting in. If corporate expansions halt, jobs in tech and financial services are impacted, and the flow of high-earning relocations slows, buyer demand collapses. Inventory is surging dramatically across Dallas and its suburbs, up 45% year over year, and homes are sitting longer, average 75 days. Price cuts are rampant. The substantial investor activity during the boom means many are now looking to exit, further overwhelming the market. Dallas's immense scale and past growth make its potential hollowing out a truly concerning prospect where the bubble's impact is widespread and severe. Number 4, Boise, Idaho. Now let's talk about Boise, a city that's become the poster child for just how fast fortunes can change. Not long ago, Boise was riding high. Between 2019 and 2022, home prices doubled, from $285,000 to almost $575,000 as newcomers and remote workers flooded in, eager to grab a slice of the boom. The energy was wild. Houses vanished in bidding wars. Investors snapped up everything in sight. For a moment, it felt like the growth would never end. But in 2025, reality has set in, and it's harsh. The cracks in the market have turned into massive, gaping fault lines. Inventory has exploded. Homes that used to fly off the market are now sitting for 140 to 150 days, collecting dust as buyers disappear. Those who jumped in at the peak are now deeply underwater. Investors who hope to cash in quickly are dumping properties at rock-bottom fire sale prices, just trying to stem their losses. For local families, the situation is even tougher. Mortgage rates stubbornly above 7% have pushed monthly payments on a median-priced home past $3,800, putting ownership out of reach for many. Rents have started falling, and the city's outskirts are dotted with empty subdivisions, reminders of reckless overbuilding and just how quickly demand can vanish. To make matters worse, foreclosures are on the rise again. The echoes of 2008 are hard to ignore, but this time the risks cut even deeper. Experts warn that Boise could see home values collapse by as much as 60%, swinging prices all the way back to pre-pandemic levels. In so many ways, Boise isn't just caught in the crash, it's leading it, offering a chilling warning of what unchecked growth and frantic speculation can do when the tide goes out. Number 3, Las Vegas, Nevada. Las Vegas thrives on risk, but this time the house is unequivocally losing after a wild pandemic-era boom. The Vegas housing market is now collapsing faster than a busted flush. From 2020 to early 2022, median home prices shot from $290,000 to over $460,000. That's a staggering 58% spike, recklessly driven by out-of-state investors and dirt-cheap interest rates. By 2025, the cards have devastatingly turned, and Vegas is heading for a housing bust that could tragically rival 2008. The market is in an alarming freefall. Inventory is ballooning relentlessly, more than doubling in the past year. Homes that once sold in a weekend now sit for 3 to 4 months. Price reductions are ubiquitous. Over 40% of all listings are now aggressively discounted, many by $50,000 to $150,000. The primary culprits: reckless overbuilding and rampant over-speculating. Now that speculative investor class is in full liquidation mode. Rents are dropping, and critical Airbnb income has utterly dried up. Mortgage rates, stubbornly over 7%, have transformed once hot Vegas homes from prized commodities into financial deadweight. Even worse, local wages never justified the frenzied price run-up. Las Vegas remains dangerously reliant on tourism and entertainment jobs, many of which haven't returned to pre-COVID strength. That makes the market exceptionally sensitive to broader economic slowdowns. Should current grim conditions persist, analysts grimly expect home values could regress to pre-2020 levels, meaning a brutal 60% plus correction is absolutely on the table. In Las Vegas, the real estate dream has brutally materialized as just another illusion, now melting under the intense heat of higher rates, weak demand, and catastrophic oversupply. Number 2, Cape Coral, Florida. Let's take a closer look at Cape Coral, a place once touted as Florida's hidden gem, the last affordable waterfront paradise. It was the dream for so many. But now in 2025, that dream's become a nightmare at the heart of Florida's housing collapse. During the pandemic frenzy, Cape Coral's market took off at breakneck speed. Median home prices more than doubled, soaring from about $230,000 in 2020 to over $470,000 by 2022. It felt unstoppable. Developers jumped in with both feet, building thousands of new homes, sometimes entire neighborhoods at a time. But things turned quickly. Today, many of those houses sit empty, and builders are slashing prices by $60,000 or more, even paying buyers insurance to sweeten the deal. Still, buyers aren't biting. The troubles run deeper. Skyrocketing insurance premiums, some topping $9,000 a year thanks to the escalating flood risk, have hammered affordability. Property taxes are climbing. HOAs are demanding more cash. And for many, holding on to a slice of paradise has simply become impossible. All this has triggered a mass exit. Retirees and investors are leaving in droves, and inventory has exploded, now triple what it was in 2022. Over half of the homes on the market have been hit with steep price cuts, and the average time to sell has doubled. If this relentless pressure keeps up, experts say prices could fall to below $200,000, marking a brutal drop of 60% or more from their highs. What was once a warm Florida dream now feels like a ticking financial time bomb. Cape Coral's story is a stark warning. When a market overheats and the costs keep rising, even paradise can turn perilous in a heartbeat. Number 1, Phoenix, Arizona. Phoenix isn't just having a rough patch, it's at the eye of the 2025 housing storm. Between 2019 and 2022, prices rocketed from $280,000 to almost $510,000, fueled by a rush of investors and families hoping to cash in on the city's boom. But what rises quickly can fall just as fast. Now, homes are taking months to sell, and more than half of all listings have seen price cuts. some slashed by $100,000 or more. Inventory has quadrupled, and sellers find themselves waiting as buyers disappear. The investor frenzy has flipped to panic. Properties are being dumped in fire sales, especially by iBuyers and big landlords looking to escape mounting losses. Locals feel the sting too. Mortgage rates above 7% mean monthly payments have soared, and many families are priced out. On the outskirts, neighborhoods like Buckeye and Queen Creek are dotted with unsold new builds and builders desperate for buyers. Foreclosures are creeping up. Households that stretched their budgets in the boom are struggling to keep up, and even FHA loans are starting to go under. Experts say Phoenix could see home values plunge by as much as 60%, wiping out most of the gains since before the pandemic. For a city that once seemed unstoppable, Phoenix now stands as a dramatic warning. Sometimes, the hottest markets fall the hardest. The takeaway is simple. The 2025 housing crash isn't a warning anymore. It's here, and no city is completely immune. Formerly booming markets are now overwhelmed with listings, steep discounts, and anxious sellers. Home equity is disappearing overnight, and mortgage payments are crushing families everywhere. Builders are nervous, buyers are scarce, and investors are scrambling to get out before things get worse. So if you're thinking about buying, play it smart, do your research, and don't assume every sunny spot is a safe bet. Some markets won't bounce back for years. If you found this helpful, like and share the video, and hit subscribe to stay ahead of the next shift. Sometimes, knowing where not to buy is the best move of all.